In this video, I am analyzing companies like Hdfc, IndiaBulls, LIC Housing, Canfin Homes and PNB Housing, which is Punjab National Bank Housing. These companies are in financing of home loans. We are going to compare HDFC with these peer group companies and understand how these companies stack against each other. We will also try to understand where the valuation metrics are, where the profitability growth is, and how efficient the company is in managing its different resources. HDFC's current market price is 2,278 and it has fallen from its 52 weeks high by 1% only. IndiaBulls has fallen 47% from where it was 1 year back. LIC and Canfin has fallen 3.5 and 5.1% each. PNB also saw a big fall in its price from 1 year back. Here we want the companies to not fall at a very high rate from where it was 1 year back, although it creates a buying opportunity provided all other metrics and ratios are in order. But generally we will consider that the lower the fall, the better it is, and more the fall, the weaker the stock is. Let us look at the earnings yield. This is the ratio which is calculated by comparing the profit that the company has earned on the price that the investor has paid. For HDFC, the company's profit was 56 rupees for the price of 2,200. That is a yield of 2.5%. IndiaBulls' earning yield was highest in the group at 13%. For a price of 727, the company was earning 95 rupees, which works out to an yield of 13.2%. LIC and Punjab National Bank both have earned an yield of more than 8% each. Canfin's earning yield was 6.2% on a price of 366. The earnings or profit for the share was 22 rupees. Here we want the earnings yield to be as high as possible. Next, let us look at the price earnings ratio of the current 12 months, or also known as PE, price to earnings ratio. Here we are comparing the current 12 months earning against the current price, and this ratio will tell us how far away the price is from the earnings, or how near the price is compared to the earnings of the company. Here we want the price earning ratio to be as low as possible, possibly below 25 times. We don't want to pay a very high price for the earnings of the company. All companies except HDFC had a low price earnings ratio compared to HDFC, which had a PE of 40 times, which means the price was 40 times more than the company's earning for that share. The company's earnings was 56 rupees and the price was 40 times more than the earnings. IndiaBulls price earning of the recent 12 months was 7.6 times. Again, that means the price, that is 727, was 7.6 times more than the earnings of the company per share of 95 rupees. Similar is the case for LIC, Canfin and PNB, whose price earning is below 17 times. Here, as I mentioned earlier, we want the price earning to be as low as possible and below 25 times at least. Let us look at historically where the price earnings was trading for these companies, and also we have the data for last 3 years average price earning. This will help us understand where the price earning was trading historically and help us understand if the current price earning is high against the average of the 5 years and average of the last 3 years. HDFC current price earning, which is 40 times, is above its averages of both 5 years and 3 years. IndiaBulls current price earning has fallen below its averages. So has the same thing happened for LIC Housing, whose current price earning of 11 has fallen below the averages of both the 5 years and the 3 years. In case of Canfin also, a similar thing has happened. Its current price earning of 16 times has fallen below the 5 years average of 17 and last 3 years of average price earning of 20 times. Here, in the last 5 years on average, the price was trading 17 times higher than its earnings. So we get a feel as to where the current price earning is compared to its 5 and 3 years averages. PNB also price earning has fallen almost 50% below its 5 years and 3 years price earnings. Next, we'll move on to the second valuation metric, which is the price to book value, which signifies where the price is against the book value of the company. Book value is the value given to the share by the company. This is what the company thinks its shares are worth against the market participants who think the share should be given a premium or should be traded at a discount to its book value. Here we don't want the ratio to be more than 2.5 times, meaning as investors we should not pay more than 2.5 times more than what the company is saying its shares are actually worth. HDFC was trading at a premium price to book value of 5.1 times. Its market price was 5.1 times higher than its book value. IndiaBulls, LIC Housing and PNB were trading below 1.9 times. Canfin Homes price to book was 2.7 and above my benchmark of 2.5 times. Next, let us look at price to sales. This is also a valuation metric. This will also help us understand where the price is compared to the sales per share, or as a whole, how much sales the company has done against the market cap it is commanding. HDFC's total market cap was 9.1 times higher than what it did in sales in the latest year, meaning the total market value of the company was 9 times higher than its sales. Here we don't want to pay a very high price against the sales of the company for the current year. We want the market cap or the price of the share to be as near to what it has done as sales. This will justify that we are not paying a very high price for the shares against the sales that the company has done. HDFC current price to sales ratio was 9.1 times, as we saw earlier. IndiaBulls price was 1.9 times higher than its sales. That is, its total market cap, or as an individual value, we can say that the price was 1.9 times higher than the sales per share, or as a cumulative, we can say the market cap of the company was 1.9 times higher than its entire sales for that year. As I mentioned, we don't want the price to sales ratio to be very high. In this case, we see HDFC has been trading, or the price is trading at a premium of 9 times against the sales the company has done. Canfin Homes price to sales was also high at 2.8 times its sales. Next, we'll look at the growth ratio, that is the profit growth over a period of 5 years. This is the CAGR growth rate that we are looking at. Here we are measuring how the profit is growing from where it was 5 years back, and also from where it was 3 years back. This helps us understand how well the company is managing to grow its profit year on year over a period of 5 and 3 years. We want the profits to grow year on year at least 10% rate. All of these companies have managed 10% and above growth rates. LIC and HDFC had a minimal profit growth rate of 14%. Other three companies have grown their profits over the last 5 years at more than 20%. When we look at the last 3 years growth in profit, both LIC and HDFC again have grown their profit at a low rate compared to the peer group, which have grown at more than 20% since the last 3 years. LIC's profit in the last 3 years has fallen, and it is currently at 12% growth rate, whereas HDFC has seen its profit growing in the recent 3 years at 15.9%. Next, let us look at the price earnings growth rate. The price earnings growth rate is calculated by dividing price to earnings by the profit growth rate of 5 years and profit growth rate of the last 3 years. This helps us understand the price to earnings that we are paying for the company. Is that high or low? For example, for HDFC we paid 40 times the earnings, as I mentioned earlier, and we are getting a growth in that earnings since last 5 years of 14% and last 3 years at the rate of 15%. So we can see that although we are paying 40 times, we are getting a growth rate in that earnings of 14%. So we will be able to recover our capital much faster and we want the PEG to not exceed 1.5 times. Many investors would like the PEG to be below 1 time. But not many companies would give you a PEG of below 1 times if there is not growth in those companies, or if those companies are trading at a high price to earnings valuation. HDFC's PEG ratio was 2.9 and 2.5 for both 5 and 3 years, which signifies to us that the price earning that we are paid is quite high because the corresponding growth in profit is not there. To give you another example, in IndiaBulls, the PEG is 0.3 for each 5 and 3 years, which then signifies that the price earning, that is 7.6 times the earnings that we paid, for that we are getting a growth in the earnings. Even LIC Housing, Canfin Homes and PNB have a good PEGs of less than 1. The price earnings that we paying for all of these three companies justifies because we are also getting a high growth rate in profit for these companies. Next, let us look at the sales growth rate over the last 5 years and how the sales has been growing over a period of last 3 years. Sales is an important part of the analysis because this is where the revenue is generated and it translates into the profit. Sales shows how the company's management is efficiently growing its sales and if whether the demand for the company's products are intact. We want the sales to be also growing at 10% year on year, or as far as possible over what the group companies are growing their sales at. HDFC has been growing its sales or generating revenue through business operations at the rate of 10%. Most of these companies have a high growth rate in sales over the last 5 years. In the last 3 years, all companies had a 10% and above growth rate in sales, except for HDFC's, whose sales was increasing by 8.7%. Next, let us look at the return on equity ratio. This is the profit that the company has earned on shareholders' money over an average period of 5 years. Then we'll look at the profit that the company generated in the latest year. And then we'll compare both of them. HDFC's 5 years ROE on average was 20%, and the current ROE is below the average. We want the RoE to be above 15% at least, or whatever is the industry standard. IndiaBulls 5 years average was 28%, and the recent return on equity was 30%, which is above the average. So this is what we want to see in companies when we are looking at return ratios or profitability ratios. LIC Housing's recent return on equity has fallen below its 5 years average. Same is the case for Canfin Homes, whose return on equity fell below its average. PNB managed to increase the ROE by a 1 point or 1% above its average. Next, let us look at the growth rate in return on equity over the last 5 years. This helps us understand whether the company has been managing to increase its growth in earnings on shareholders' funds. HDFC's RoE has been falling at the rate of 3.6% over a period of last 5 years, and most of the other companies have done a mild degrowth of less than 2%. Next, we'll look at the return on capital employed over the last 5 years on average. That is, what was the profit generated on the capital which was employed into the business. Here we have to understand two things. One is the profit and the other is the capital employed. In this case, the profit that I am referring to is the EBIT, EBIT, or earnings before interest and tax. And capital employed is the fixed assets which are employed in the business and any working capital. The working capital again is made up of current assets and current liabilities. We remove the current liabilities from the current assets and we get the working capital. Current assets and liabilities are those assets and liabilities which have to be sold or which are to be cleared off, as in liabilities, and in terms of assets sold off within 1 year. So we are looking at how the company has generated profit on the capital employed into the business. We want the RoCE to be at least 15% and above, or at least in line with what the peer group companies are generating. RoCE over the period of last 5 years on average was above 10% for most of these companies, except for PNB, which fell slightly below 10. In terms of recent RoCE, that is for the latest year, HDFC's return on capital employed is below its average of 5 years. IndiaBulls also, along with LIC and Canfin, in fact PNB too, all of these companies' recent return on capital employed has fallen below its 5 years averages. We want the return on capital employed, as I mentioned earlier, to be more than 15%. Next, we will look at the return on assets. The assets in this case is the total assets of the company, and we remove out the current liabilities from that. So here in this case, we are considering all assets except for current liabilities, that is after deducting of current liabilities. Here we want the return on assets to be as high as possible. There is no benchmark as such. HDFC's return on assets, that is total assets employed into the business and the profit generated on it, was 2.6%. Here the profit value we are considering is the net profit. IndiaBulls returned the highest RoA over a period of 5 years on average of 3.7%. Other group companies have managed to return less than 2% over a period of last 5 years. Next is the asset turnover, that is how many times the assets were turned over into sales in the latest year or in the last year. Here we have to understand what is assets again. This is composed of the net worth of the company plus the borrowings. The net worth is calculated by removing out all liabilities or paying off all liabilities by selling all assets of the company, and we get the net worth, and we add that along with the borrowings to consider the assets in this particular case. The higher the turnover of assets into sales, the better it is. In this case, since these are finance companies and they work on high leverage, their asset base is huge, because of which the profit that they generate looks very small compared to the assets. So we will not get very high return or assets turnover. In this case, for almost all the companies, the sales was just 10% of the total assets employed into the business. Next, we'll look at the return on invested capital. This is again a return ratio or a profitability ratio. Here we are looking at the profit that the company has generated using the investable capital. In this case, investable capital is made up of the net block and the difference of working capital. In this case, net block means the total assets of the company deducting depreciation means net block. Plus we add the difference of current assets minus current liabilities. So this is the actual assets which were now employed into the business, and they reflect the true picture of how the company is generating profit on what is invested into the business. Hdfc has generated a 2.3 times more than its investable capital, or 230% more than investable capital. Most of these companies have a high returns on investable capital or invested capital because their operating expenses are very low. So in most of the finance companies, you will see a high return on invested capital. Let us now look at the profit values, or how the company has grown its profit over its 5 years average and how the profit has grown year on year. So we have the average profit values of the last 5 years, and we will see how the company has generated profit in the recent 12 months and what was the profit generated in the previous year to that. The company's recent profit of 9,632 CR was 36% above its 5 years average of 7,000 CR. So this is a good value because the current profit is above its average. And if you look, most of these companies have their recent profits above their averages. The highest profit generated above the average was by PNB Housing at 82% above its average, and IndiaBulls at 62% above its average. In terms of growth over its previous year, most of these companies have shown a higher growth in profit over its previous year. LIC Housing had a 22% growth in its profit from the previous year. PNB too had a 28% growth rate in profit. And the other three companies have grown at less than 7%. Now we'll move on to analyzing the quarterly sales and profit growth. how the profits and sales have grown in the recent quarter, that is YOY or year on year growth or quarter on quarter growth. We want the sales and profit to grow at least 10% and above. In terms of sales, all of these companies have generated 10% growth rate in sales except for IndiaBulls, whose sales was 5.2% from its previous year's quarter, that is from March 2019 to March 2018 comparison. In terms of quarter on quarter sales growth rate, that is from December 18 to March 2019 quarter, only IndiaBulls Housing's sales fell by 6%. Rest all the other companies have managed a growth in their sales. In terms of profit, again, 3 companies have grown their profits. HDFC, LIC and PNB have grown their profits YOY, and IndiaBulls and Canfin saw a drop in their profit by 7% and 9%. In terms of recent quarter growth rate in profit, all companies except Canfin again had a fall in its profit by 10%. So not only the profit has fallen from 1 year back by 9%, but over previous year quarter also it has fallen by 10%. So what happens is, when we analyze the quarterly data along with other values, we see the near-term picture as well as the long-term values or ratios, or how the company was doing in last 5 years, then in 1 year, and then in the very recent quarters. So we get a holistic view of the fundamentals of the company or the working of the company. Next, we'll look at the size of these companies, not the market cap, but the net worth or actual values of these companies. The difference between net worth and market cap is that net worth is calculated by the company, whereas market cap is calculated or is valuations are given by the investors in the share market. I am actually interested in mostly looking at net worth. That helps me understand what is the actual size of the company. HDFC, with its sheer size of 77,355 crore, is the largest of the group companies. Canfin is a small cap in compared to HDFC at just 1,782 crore. Contingent liability. These are the liabilities that may or may not arise in the future, and the company has not made any provisions or entry regarding these liabilities in its balance sheet. These liabilities are shown in the notes section of the annual reports, and we have to be very careful that the companies don't generate too much of contingent liability, because that may arise in the future, for which the company may have to pay, and that would directly affect the shareholders' profit. In this case, my criteria is that contingent liability should not exceed 20% of the company's net worth. And as we see, none of these companies have a high contingent liability. HDFC's contingent liability was highest at 5% of its net worth. Its contingent liability was 3,800 crore, almost as good or almost more than what the Canfin Homes net worth is. But in this case, since its net worth is very high, its contingent liability to net worth ratio is just 5%, which is still a lot better. Next, we'll look at the debt to equity ratio. This is the comparison of the total borrowings against the contribution of the shareholders. We don't want a very high borrowings against the shareholders' money. The more the debt or more the borrowings, the more interest the company has to pay to the banks and financial institutions, which will eventually reduce the profits that would go to the shareholders. Since these are financial companies, their debt to equity ratio will be high. In normal companies, we don't want the debt to equity ratio to exceed 1 times. HDFC's borrowings were 10 times higher than the equity shareholders' money. IndiaBulls' debt to equity was 6.1 times, which is the lowest in the group companies. LIC too was at 10.6 times its equity. Canfin's debt was 9.4 times its equity contribution. PNB also had a similar debt to equity ratio of 9.7 times. Here, the lower the debt, the better it is, because as I said earlier, more borrowings means more interest cost the company has to pay. So next we'll look at the interest coverage. In this case, we are trying to understand how much is the earnings before interest and tax that the company has earned, and on that what is the interest it is paid, what percentage is the interest against the EBIT that the company has earned. This helps us understand the difference or multiples of EBIT with the interest cost. HDFC's EBIT or earnings before interest and tax was 1.5 times higher than what it paid as interest cost. IndiaBulls and all other companies were below 1.6 times. Most of these banks, since they have a very high debt, their interest coverage will be below 1.5 times at most of the times. Here we don't want the interest coverage to fall below 1 times. When the ratio or when the interest coverage is at 1 times, what it signifies is that the earnings or EBIT is equal to the interest cost, meaning whatever is the EBIT is the interest cost is also similar to the EBIT. In other words, we can also look at it in this way. The EBIT is 0.5 times higher than the interest it paid in the latest year. Next, we'll move on and look at the debt to profit ratio. This ratio helps us understand the debt the company is carrying and its ability to service the borrowings or the interest from that through its profits. This is the efficiency ratio. HDFC's borrowings of this year were 6.4 times higher than the profit it earned. So here we are looking at the borrowings to be as low as possible against the profits of the company. In this way we can understand that if the company HDFC has to clear off its debt, then it will take it 6.4 years with existing profits to clear off that debt. IndiaBulls will take 26 years to clear off its borrowings considering this year's profit value. LIC will take 13 years. The other two companies, Canfin and PNB, have a very high borrowings against the profit of the company. PNB will take 66 years, or we can also say it in another way that the borrowings is 66 times higher than the profits the company has earned in the latest year. Next, we'll look at the promoter holding and the pledge, if any, that the companies have done. The pledge basically signifies if the promoters have given their shares or taken loan against their shares by keeping these shares pledged with the banks. We don't want the pledge to exceed 20% of a promoter's holding. When the promoter's pledge increases above a certain level, let's say 20%, it signifies that the promoters are exiting not directly but indirectly, and they are taking up loans or they're borrowing on their shares from the banks. And in case if they don't pay off those loans, the banks would sell off those shares in the open market, which would basically take the prices down at a very fast level. The promoter holding also is a very important metric that we should look at, because it signifies the stake the promoter has in the company. The more the promoter's shareholding, the more interest that I'm assuming the promoter will take in running the business operations, and that will benefit the shareholders. Promoter holding, as far as possible, anything above 40% is always good. The banks will have, as per the rules and regulations, banks' promoter holding is generally below 20%. All companies had above 30% of promoter holding except IndiaBulls, whose promoter holding was just 21%. And not only that, but it had pledged 12% of its shares. So here, this is the only company where promoter holding is low and there's a high pledge against the promoter's holdings. None of the other companies have any pledge against the shareholding. Hdfc doesn't have any promoters. Most of the shares are owned by foreign institutional investors, and there won't be any pledge because there is no promoter in this particular company. Next, we'll look at the return ratios or profitability ratios. The operating profit margin signifies what is the top line growth in earnings of the company. This is the profit which is generated through the operations of the business. Here we are looking at the 5 years average operating profit margin. Most of these companies' OPM will be very high because, as I said earlier also, their operating expenses are very small compared to the revenue that it generates because of the leverage. In normal companies, which are basically non-banking companies, their OPM should be above 15%. Let's look at the net profit margin of the last year. Most of these companies have earned above 10% of net profit margin. This is the profit margin that the company has shown after deducting all expenses, whether cash or non-cash, from the revenue it has generated through sales. We want the net profit margin to be above 10%, which most of these companies have generated. When we look at a year prior to that, here too we see most of these companies' margins were above 10%. Next, let us check out the current ratio. This ratio is a liquidity ratio which measures the company's ability to clear off their current liabilities, that is, those liabilities which they have to pay in this year or which they have to clear within 1 year, using the current assets which they own and can be sold within 1 year. So this basically indicates how liquid the company is. Would the company be able to clear off their current liabilities which they have to pay using the current assets? Here we want the ratio to be 1 and above, meaning current assets should be as good as the liabilities that the company owns or has to pay off. Most of these companies were able to sustain paying off their current liabilities very easily. Next, we will look at the gross block, that is the total assets that the company owns as of today at its acquisition cost. and then we will see how much the company's accumulated depreciation against that gross block has taken place. Net block would indicate the depreciation deduction on the gross block and adding any new assets in this year to the fixed assets. On that, what is the depreciation rate charged by the company, or how quickly the company is reducing the value of those assets from its balance sheet and showing as expenses in the P&L account. These comparisons will look at through the accumulated depreciation on the gross block and the depreciation rate charged on the net block. Here we want that up till now most of the company's assets should be depreciated off. In this case of HDFC, they had the total assets of 1,536 CR. Of that, 476 has already been depreciated, and that works out to 31% of the gross block, which would indicate that they still have to go 69% over the next few years. Here we want the depreciation, accumulated depreciation, to be as high as possible, which would indicate that in the future years there wouldn't be too high a depreciation being charged to P&L account. After removing out depreciation or reducing the value of the gross block, we get the net block. Here the values may not match because there may be some additions in the current year to the net block or net assets. On the net assets, the company has charged a depreciation of 49 CR. That is a 5.1% depreciable rate. The depreciable rate of assets is very low for HDFC. It is depreciating its assets at a very low percentage compared to the peer group companies. The highest depreciation on the net block was by Canfin Homes at 30%, and its total gross block already has been depreciated till 68%. So in the future years, if they don't increase their net block, then we can expect higher profits from the company, as the depreciation charged to P&L would keep reducing. So this helps us understand and analyze how the depreciation will affect the company's future profit values. Next, we'll look at the dividend yield that the company has generated on the current price using the last year dividend that the company paid. Highest dividend yield was by IndiaBulls Housing at 5.6%, followed by LIC Housing and PNB Housing. Both of them have given a 1.2% of dividend yield. This is the benefit or a bonus for the shareholders for taking risk in the company. This concludes the analysis of these companies which are into housing finance. Let me give it the ranking and then we will continue with the analysis. I have ranked these companies and color coded them. Green indicates the highest score for that particular ratio, and blue indicates second highest score. Red indicates low values for that ratio. HDFC had the least fall, or it is very near to its highs of 1 year, along with LIC, which has also fallen or has not fallen that much from its 1 year back value. IndiaBulls and PNB has fallen the most at 47 and 45%. In terms of earnings yield, highest earnings yield was seen in IndiaBulls at 13%, followed by LIC at 8.5%. HDFC and Canfin performed poorly in terms of earnings yield. In terms of current price to earnings ratio of the recent 12 months, HDFC was very expensive at 40 times its earnings. Canfin was available at 16 times its earnings, the second highest in the group company. LIC and IndiaBulls were available at a low valuations of 7.6 times and 11.8 times. I haven't given ranking to the 5 years historical price earning as well as 3 years historical price earning. The current market price to book value was best for IndiaBulls and LIC. Both were available at below 1.9 times. Even PNB was available at 1.8. HDFC was very expensive at 5 times its book value. Here we don't want to buy a company which is trading at high premium valuations. We can wait out, and whenever price to book value falls below 2.5 or even nears 3, we can think about entering the script. The price has to fall here. In terms of price to sales, HDFC again was at a very high valuation. Its market cap was 9 times higher than its sales. Both LIC and PNB were available at a low valuations. In terms of growth in profit, PNB has seen the highest growth for both 5 and 3 years at more than 40%. HDFC's profit growth rate was low along with LIC, although these values are still very good because they are above 10%. But in terms of peer group comparison, these values are very low. Or we can also say that the PNB Housing's value is very high and needs to be checked if the base year's profit is very low, because of which these profit values have been inflated or not. In terms of PG, that is the price earning that we have paid against the profit growth rate that the company has generated. We see PNB has done very well along with IndiaBulls, and the price earning valuations are justified for both of these companies. Even for LIC and Canfin, the price earning paid is justifying because we are also getting high profit growth rate. I'm just recapping recapping these ratios again to quickly analyze through these metrics. In terms of sales growth, IndiaBulls and PNB both had shown a high sales growth as well as high profit growth rates. HDFC's sales growth rate was low at 10% and 8%, along with LIC at 14 and 11%. Even these values are good. Again, for peer group comparison, these values are low. ROEs or return ratios were good for IndiaBulls as well as HDFC. LIC has done poorly at 18% and 16%, along with PNB. Again, as I keep saying, these ratios are peer group comparison values, and although these are normally high values, but in terms of comparison, they have fallen low. That does not mean that these companies are not good. In terms of RoCE, again, IndiaBulls has performed the best, and LIC Housing's return on capital employed was low at 10.3 and 9.6% for both 5 years average and for the single year. Return on assets was lowest for LIC Housing at 1.5. IndiaBulls gave a good return on assets of 3.7%. In terms of invested capital, the returns generated was highest for Canfin and LIC Housing, and IndiaBulls and HDFC gave the lowest returns of 230% and 126%. The highest profit, current year's profit above the average, was seen in PNB at 82% above the average, and the lowest profit was seen by HDFC above the 5 years average at 36%. YOY growth rate in profit was seen highest for PNB at 28%, and the lowest growth rate was Hdfc and Canfin, whose profits were growing at 3.4 and 3.7%. In terms of quarterly growth rates in sales and profit, Hdfc has done the best in the peer group companies along with PNB Housing. Both Canfin and IndiaBulls have performed poorly in the recent quarters. Net worth wise, if you see, both Hdfc and IndiaBulls are the big companies along with LIC Housing, and Canfin and PNB are small cap companies or mid cap companies, we can say. All these companies had very low contingent liability to net worth ratio. The debt to equity was seen lowest for IndiaBulls as well as Canfin at 6.1 and 9.4 times. Hdfc and LIC Housing both had a very high debt against their equity. But when we look at the coverage, Hdfc and IndiaBulls have managed to cover their interest with EBIT at highest rates. LIC and PNB had a 0.3 or 1.3 times the EBIT was 1.3 times its interest payment. Debt to profit wise, Hdfc was best. So here we can see, although debt to equity was 10 times for Hdfc, but profit it generated was very high. So its borrowings were just six times its profit, whereas for LIC it was 13 times, even though their debt was 10, almost similar to the debt to equity values. But in terms of borrowing to profit, Hdfc has generated higher profit for their borrowings against LICs. Canfin and PNB Housing's borrowing to profit was very high at 56 and 66 times, which means the borrowings were 56 times higher than this year's profit. In terms of promoter holding, all of these companies have below 40%. The highest holding was LIC at 40%, and Hdfc had no promoter holding at all. Even IndiaBulls promoters holding was very low at 21%. The highest pledge was seen in IndiaBulls. None of the other companies have made any pledge. 5 years OPM and NPM was seen best for Hdfc and IndiaBulls. Current ratio wise, both IndiaBulls and Canfin have done nicely to cover up their liabilities. LIC and Hdfc have low current assets, or not have current assets but not up to the mark what IndiaBulls and Canfin has. In terms of depreciating the assets, the highest accumulated depreciation was for Canfin and LIC, and the depreciation rate charged highest were again by Canfin as well as IndiaBulls. The depreciation rate charged by Hdfc was low at 5.1%. Even LIC was charging or depreciating its assets at a very low rate of 7.4%. The dividend yield was seen highest for IndiaBulls on the current price, which is a good thing, followed by 1.2% for both PNB as well as LIC. Finally, I have accumulated all of these ratios into few metrics, 6 in total, and I have categorized it and arranged it in terms of their importance for me. Efficiency is a very important metric for me, and I would want to see this metric first before I go to the valuation, where the price is. Efficiency ratio is basically how the company is managing its depreciation on its gross block or its net block. Then we can also see how much the promoter holding has been pledged, or what is the holding of the promoters in the business, and how well are they managing their borrowings against the profit, against the equity, how well are they able to cover their interest cost, and so on. So these are the efficiency ratios, how well they have converted their assets into sales. These are the efficiency measures which shows how well the management is doing. Then we have solvency ratios, which is current ratio, how liquid the company is, have the promoters pledged any of their shares, what is the promoter holding. So this is the liquidity ratio that I have considered. Since most of these finance companies cannot be analyzed for cash flow metrics, I have not given any score here. In terms of growth in profit and sales, we see that PNB's profits and sales were growing at a very high pace, the highest in the group, followed by IndiaBulls Housing. Return ratios or return metrics are profitability metrics, which shows how much profit the company has earned on shareholders' money, or on borrowings, or on assets, and so on, like on working capital. And finally, we have the valuation metric, which measures the price and where the price is compared to different variables like earnings, sales, book value, and so on. So finally, when we conclude, the highest score was for IndiaBulls Housing at 20 points. This is because it has got the highest in efficiency, highest in growth metrics, and highest in return and valuation metrics. The valuation metrics are because the prices have fallen at a very high rate, because of which the valuation has become the best for IndiaBulls. Even in terms of profitability, it is very high at 46 points of all the ratios, which translates to highest score for return metrics also. LIC Housing has done the second best at 15 points. Its efficiency is at 3 points, solvency at 3 points, growth at 3 points, and the return ratios are poor for LIC, although valuation metrics are very good. It is available at a very good valuation, second best valuation. PNB and Canfin have got both 14 points, and HDFC has got the lowest point, but it does not mean that HDFC is not worth or not a good company. It's just that in terms of valuation, it has got the least. Also in terms of solvency, it has got the least value, and growth wise also, it is not growing at a very high pace which other companies are growing at. So this concludes my analysis of these companies. Investors can look at these metrics and conclude for themselves which of these companies are worth buying or entering into. Thank you for watching this video.